We all hear a lot of so-called facts that we just accept as gospel. Things like it takes 7 years to digest chewing gum, or that goldfish have 3-second memories. While these and other so-called facts don't affect your life in any meaningful way, we also hear loads of facts about investing that could prove dangerous if we rely on them when building our portfolios, but are then later proven to be incorrect.
There are hundreds of these so-called facts that we just accept because some faceless analyst or reporter says so. We personally like to verify as much as we can, but we're often hamstrung by our lack of accessibility to good data. Detailed financial data seems to be only available to the billion-dollar financial institutions.
In this video, we're deep diving into the last 33 years of S&P 500 total return data to find out the real facts. We'll learn what the overall returns were, the impact of exchange rates, the frequency of corrections and crashes, the effect of missing the best trading days, how long it takes to recover from a crash, and more. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. This video is sponsored by Genuine Impact, the research and analysis tool that provides insights for investors. Genuine Impact is an app for analysing and comparing stocks and ETFs using a ranking system that sorts investments by quality, value and momentum with a simple user-friendly interface.
It can analyse your portfolio with features like Portfolio Breakdown and Top Holdings Inspector, and it also has search and filter compatibility with popular apps like Freetrade and Trading 212. New users to Genuine Impact will receive 1 month's premium access for free when you sign up via the link on Unshackled.com, linked to below. Be sure to check them out. Now let's get into the video.
The S&P 500. Here, we're looking at the S&P 500 over the last 33 years or so, and no doubt every investor will be familiar with this chart. Although the S&P 500 is the most widely reported index in the world, we're not overly keen on price charts like this. The problem is, indexes like the S&P 500 and the FTSE 100 are price indexes, which means they only consider the price movements of the stocks within the index and ignore the payments of dividends. This is a poor way to measure the true return on investment.
A better reflection of total performance is a total return index. Here is the S&P 500 total return index for the same 33-year period. A total return index accounts for any dividends paid by reinvesting them. Without looking at the axis, at first glance you might think that both indexes were identical.
Let's compare the two by rebasing them, so they both start at 100. Over time, the total return index powers ahead, although the highs and lows of price movements still apply. In 33 years, the price index has returned 8.8% per year versus 11.1% per year for the total return index. Or to see the magnitude more clearly, it is a return of 1,669% for the price index versus 3,343% for the total return index. That's more than double.
When investing, the main thing to care about is your total return. On their own, price movements or dividends don't show the whole picture. So when someone says the FTSE 100 has returned nothing in 20 years, that's not an accurate assessment.
The S&P 500 for UK investors, exchange rate impact. As UK-based investors, when we invest in foreign markets like the S&P 500, our total return will also depend on exchange rate movements. So, looking at the S&P 500 total return data, is currency risk something that UK investors need to be worried about? Let's take a look at the S&P 500 total return index in dollars and pounds on a logarithmic scale that has been rebased so they both start at 100. A logarithmic scale is simply a way of displaying data that covers a wide range, as it displays relative movements better.
As you can see, the effect of exchange rates does cause the pound version of the S&P to deviate slightly from the normal dollar version. But is this enough to make the exchange rate a concern? Probably not. Certainly not a deciding factor in whether you should wait to invest, and probably not worth hedging either. As we said, the dollar version of the S&P 500 total return produced an 11.1% annual return, but the GBP version returned 12.2% annually, and this incredible average return is without resorting to timing the market.
In the 33 years, the GBP to USD FX rate has been all over the place, starting at 1.9, dropping, and then climbing to around 2.0, before dropping to where it sits today at just below 1.4. On the assumption that you will be drip feeding money into your portfolio for decades before slowly drip feeding it out as you spend it in retirement, we think currency fluctuations will mostly balance out, so it's something you don't really need to worry about. If anything, we'd expect the dollar to continue the long-term trend of slowly getting ever stronger, so would enhance returns for UK investors.
Consistent returns despite events. The average total return of 11.1% in dollar terms over the 33-year period makes it sound like a smooth ride, but that of course wasn't the case. Let's go back to the S&P 500 total return chart. There are clearly three defined periods. The first 12 years saw an epic stock market boom. Investors could have 8x'd their money.
From 2000 to around 2011, there was massive volatility, which saw the index go nowhere. The media would have mostly portrayed this as an awful time to invest. The decade was scarred by terrorist attacks, wars, and finished off with a huge financial crash. Sadly, we were too young to invest back then, but this would have been an incredible investing opportunity, which we'll take a look at in a moment.
And finally, the last decade has been another boom, but not on the scale of the first. So far, investors would have roughly quadrupled their money since 2011. Let's take a quick look at how consistently returns were made. From the 33-year dataset, only 6 years saw negative returns, although most of those were very nasty. From this we see that as long as you can take the rough with the smooth, you would do very well in the stock market. But would being armed with some data about how often market crashes happen help our chances of getting even better returns by aiming to invest most of our cash during one of these incredible buying opportunities?
How often do 10% corrections and 20% crashes happen? A lot of people think they can time the market. They're aware that crashes happen on occasion, so they believe all they have to do is patiently wait and they will eventually be rewarded. From our analysis, we don't think it's such a good idea to purposely wait for a crash.
On the flip side, many other investors needlessly fear crashes. The truth is, for anyone in the wealth building stage of their lives like us, a crash is a rare gift from the stock market gods. Out of the 8,500 trading days, or 33 years we analysed, there were only 12 10% corrections, which means they only happen on average around once every 3 years. 20% crashes are extremely rare, happening on just 3 occasions.
That's not to suggest that when the market crashes, you only have a day or two to respond. This powerful chart shows the size of the decline since the previous all-time high, with the x-axis representing the all-time high. The 2 largest crashes took years to recover, so there was plenty of time to invest at incredibly low prices. That's why this period was such a good investment opportunity. However, the recent COVID crash saw a semi-recovery in a matter of weeks and a full recovery in a matter of months.
Just as Sauron's one ring wants to get back to its master, the index wants to get back to an all-time high. Every time it falls, it makes a beeline back to the top. Out of the 8,500 trading days looked at, 858 were new record highs, a further 4,010 were in a range of 0% to -5%. The rarity of crashes means I'm kicking myself for not taking more advantage of the recent COVID crash. It could be years before we see another of that magnitude.
After a correction, how fast does it recover? Our analysis shows that most corrections recover back to their previous high in just a few months. The 2 notable exceptions are the ones that turned into fully fledged crashes, and as you'll remember from the previous charts, these took several years to recover. We have almost no recollection of any of these corrections, probably because they were uneventful and just contributing to the overall noise. Google reminded us that back in 2018 there was Trump's trade war with China, a slowdown in global economic growth, and concern that the Federal Reserve was raising interest rates too quickly. Now, it's not even a distant memory.
Don't regret missing the best trading days. We've analysed the distribution of the daily percentage movements in the S&P Total Return Index, and this is what we found. 75% of daily movements of the index are between -1% and +1%. In fact, 55% of the daily movements are positive and 45% are negative.
In this chart, we're showing all the daily movements, the positives in blue and the declines in red. Interestingly, it appears to be an exact mirror of itself. Whenever there is a fall, it is almost instantly followed by a gain of similar size, and vice versa.
These are the 10 best trading days in our 33-year dataset. We simulated what the total return would be if we missed these 10 best days. A lot of people experience a crash and react by pulling their money out of the market, so miss out on the best days that quickly follow.
Doing this would devastate your returns. As previously mentioned, the total return of the S&P for that time was 3,343%, but missing the best 10 days would result in a total return of just 1,531%. In other words, if you had invested $1,000 at the beginning and then reacted to events, your return would be just $15.3 thousand versus $33.4 thousand had you left your investment alone. Meddling would have cost you more than half your potential returns.
Should you invest at an all-time high? Looking at this chart again of the S&P 500 total return rebased, there are hundreds of times when the index is at an all-time high, and we know many investors at each point in time would have been sitting on the sidelines waiting for a better opportunity that would never come.
In 1995, 1996 and 1997, the index was regularly hitting new highs. If we hide the outcome, it would have looked like this. How many investors back then chose to wait for a crash because it had to be coming soon? Exactly the same can be said for most of the last decade.
We've crunched the numbers and analysed how quickly an all-time high is surpassed by another all-time high. Out of the 857 all-time highs, 690 or 81% were followed by another in less than 7 days, another 7.5% in less than 2 weeks. In fact, 99.3% saw another all-time high in less than half a year. As already mentioned, just 2 from 857 would have forced you to wait for several years before another all-time high was achieved.
Why index investing is your best friend? Investors' behaviour is often the cause of low performance or even losses because they tend to do the opposite of what they should. They buy high and sell low. We all know it should be buy low, sell high, but it's easier said than done. Index investing allows investors to invest with conviction, backed up by decades of positive returns, and it allows investors to sleep well at night.
But that's just index funds. The same can't be said for other investments. With stocks, you might begin to question, has the company continued to innovate? Have new competitors diluted margins? And so on.
When Bitcoin experiences its next volatile crash, will investors panic and rush to the exit and crystallize losses? We don't know what will happen with Bitcoin, and evidently it has been super profitable for anyone who has invested for a few years. But how comfortable would you be with a lion's share of your wealth in this unproven asset?
No matter the investment, anytime you read a financial article, you're probably going to come across a phrase that goes something like this: past success does not guarantee future performance. While this is an essential disclaimer to alert people to the risk, we're obviously very confident that index investing will produce solid returns well into the future by the fact that we invest a large chunk of our wealth into index trackers. As Mark Twain said, history doesn't repeat itself, but it often rhymes.
Question of the day: are you comfortable investing when the stock market is historically high? Join the conversation in the comments below.
Thanks for watching. On this channel we'll talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.